Weakening external demand is a factor in the outlook for this year. That is really the implication of the global slowing global demand, which has been affected in relatively weak exports, in particular also in other Asian economies. In recent data, we see this, that in particular manufacturing goods have been pressured. One factor in particular is our weak tech export. The tech cycle has been stronger, has been weaker than expected across the region recently, and we see this as something that will weigh on exports and activity in some of the Asian economies, in particular in the first half of the year. Let me now turn to the risks for the outlook. I think once again, in the World Economic Outlook and in our Regional Economic Outlook, we highlight that inflation could be more persistent than expected. So far, what we have seen in Asia, but also elsewhere, is that headline inflation has declined. That has mostly reflected declining commodity prices. Overall, though, inflation remains above target in most economies. There's a risk that high inflation could be stickier and last longer. In the United States, for example, markets expect inflation to remain above the Federal's 2% target over the next 5 years, and they assign a substantial probability to inflation exceeding 3%. These factors suggest that the battle to contain inflation is not yet over. And yet, monetary policy tightening has slowed down or paused in most economies in the region. Given the still substantial inflation risk, we think that monetary policy in Asia and the Pacific will need to remain tight until inflation falls durably back to the target. The main exceptions to this, and we should stress this here, are China and Japan, where output is still below potential and where inflation expectations have been muted. Now, the risk of inflation staying higher than expected for much longer also bears risk. That risk for Asia is particularly related to the possibility that U.S. monetary policy will have to remain tighter for longer or even tighter than expected. Market expectations for the future path of federal funds rate have been shifting in recent rates, and there remains a substantial gap between market pricing and the latest guidance by the Federal Reserve. This volatility, has led to market volatility and has led to volatility in U.S. Treasury yields and the yield curve, which have shifted up abruptly in the first part of the month. And then we have seen, again, abrupt falls after failure of the Silicon Valley banks. The shifts in U.S. yields have, of course, important spillovers for Asia and the rest of the world, and there are, at the moment, also concerns about negative impacts if the U.S. debt ceiling negotiations don't advance and can be resolved. The concern about U.S. and advanced economy yield volatility is that these could have potentially large spillovers to Asia. We have some estimates of these spillovers, which you can see in this chart. If such spillovers were to realize, there would be substantial pressure on exchange rates, and we would see depreciation, which then could feed again into additional domestic inflation. Our analysis suggests that this exchange rate pass-through could be problematic. Depreciation is worse for inflation than for appreciation, in the sense that the effect of depreciation are larger than so on. As inflation is already high, if such spillovers in the wake of U.S. financial market volatility were to materialize, we would have an inflation issue in Asia in the sense that inflation would stay higher and monetary policy would have to tighten more than expected with feedbacks on the regional economies. A slightly different risk picture is presented by the monetary policy situation in Japan, where there is uncertainty about the direction of monetary policy amongst a rise in inflation. Japanese government bond yields have increased notably since October. Changes in the Japanese monetary policy stance could lead to further increases in government bond yields, which then could have global spillovers through Japanese investors, which have large investment position in debt instruments abroad, including also notably in Asia. Portfolio rebalancing by Japanese investors could trigger another round of rises in global yields and lead to portfolio outflows, notably also in emerging market economies. Another risk is related to China's structural growth deceleration, which we have highlighted in the last Article 4 consultation for China. And it is important how these shifts could also affect Asia over time. In the immediate term, we expect China's economy to slow down, reflecting a decrease in productivity growth, which we have already observed in the past few years and which we expect to continue further. And it also reflects demographics, notably a shrinking labor force over the next 10 years. This will have important implications for the region, given the strong trade linkages with China. And against these medium-term growth risk, we also need to consider the risk from global fragmentation, which we have not yet included in our forecast. If global or geoeconomic fragmentation were to strengthen and materialize, then there could be large impacts on growth. We have past work, including in the regional economic outlook of last October, that this could lower the GDP levels globally by several percentage points, which would lead to a material decline also in growth rates over several years. These challenges call for structural reforms to boost long-term growth. The region should prioritize reforms that boost innovation and digitalization, which also could help in accelerating the green energy transition. Finally, let me turn to China and some of the policy advice we have been offered. In the near term, given that China, despite the rebound we see this year, has still a negative output gap, that is, the economy is still producing below capacity, we think that it is very important that macroeconomic policies stay supportive. So that's why we recommend that fiscal policy stay neutral, in particular to avoid a premature tightening of fiscal policy after the COVID support last year. We also suggest for monetary policy to remain accommodative this year. We would also highlight then that it's not just the level of support that matters. It's also how it is delivered. Structurally, I think a key factor hampering the transmission of fiscal policy impulses has been the very high level of precautionary savings that have held back consumption relative to investment and other components of demand. Going forward, we suggest that fiscal policy should pivot towards supporting households and consumption. We think that would have much higher fiscal multiplier effects than the traditional way of supporting aggregate demand in China, mainly through increased investment expenditure. As some of that investment is becoming less productive and less needed, there will be much more bang for the buck by fiscal policy support for households. And what you can see in in this chart in particular is that mean-tested transfers to vulnerable households in need of support would have much stronger multiplier effects for every one that is spent relative to untargeted transfers or relative to public investment. In the right-hand side, you can also see that there's still that China's monetary policy is accommodative, and it should remain accommodative this year. Another theme equally important is the medium-term outlook. A key concern is for China to achieve high-quality growth in the medium term. Because the reason why we put so much emphasis also in the medium term is that the boost to growth from the economic reopening this year will eventually fade. And we put a lot of emphasis on China to address some of the structural factors that have been weighing in growth. What you see on the right-hand side is our baseline we have in the past Article 4 laid out two sort of scenarios for China. One is our baseline of declining growth over the medium term from 5.2% this year, 4.5% next year, and then about 3.4% by 2028. We contrast that with a reform scenario where growth would, on average, be about 1 percentage points higher relative to this baseline. There's three types of reforms that underpin the reform scenario. One is a fiscal pivot towards supporting households. It's basically a budget-neutral shift in fiscal expenditure towards household that would start actually this year and would support the reduction in what we see as excessively high household savings rate. The second pillar of the reform scenario is the implementation of SOE reforms that would help to close the productivity gap between SOEs and private companies. That would be achieved by improving resource allocation and encouraging deleveraging among SOEs and having pro-market reforms that would then achieve more competition and help private enterprises to compete. And then the third pillar of the structural reforms are labor market reforms that would lift the retirement age, slow the impact of population aging and the shrinking labor force, and education reforms that would further improve access and improve the quality of human capital that goes to work and could increase productivity also in line with investment and higher capital and labor productivity. Overall, again, there's scope for medium-term growth above 4% with substantial structural reforms. And let me conclude here by also noting that in terms of debt, if China has higher medium-term growth, I think that would also reduce risks from higher debt, from high public debt, but also high private sector debt. So we see also a strong case for these structural reforms for de-risking the economy. Thank you.
Thank you very much, Thomas. I'm not sure if everyone can see the slides clearly, but we can share the slides with you afterwards by email. Now we're happy to take your questions. If you have any questions, please raise your hands, identify yourself with name, media organization, and try to be brief.